Now at $17.50 a share. Of course, it's lower open expected, and we are expected to go lower right now off the 252-point decline that we have. Of course, coming into it, we had a global sell-off. We had Japanese stocks down 9%, the Hong Kong markets down 8%, Singapore was down 8%, and of course the sell-offs that we are seeing in Europe today, most of those markets down about 8 or 9% as well. The concerns continue to be the deleveraging that we are seeing around the world by hedge funds and other investors, the recessionary fears that were brought to the fore today by the fact that the UK, its economy contracted for the first time in 16 years in the third quarter. Add to that the news that we're getting out of not only corporate of America, but corporations around the world. Toyota, poor sales in the U.S., basically causing it to cut its forecast for the full year. Sony also under pressure. Both of these, of course, Japanese currency companies, and of course the numbers or the warnings that we've been getting out of a number of U.S. companies as well today. Couple of points to watch today. 839.80 on the S&P 500. That was October 10th intraday low. A number of traders watching that. And just an indication on National City being acquired by PNC, down 88 cents at $1.86. The Dow Jones Industrial Average off 384 points. Now let's get a check on the Nasdaq with Scott Wapner. Scott?
All right, Mary, thanks so much. And just a note on those circuit breakers, just want to point out here that the Nasdaq does use the same circuit breaker as the NYSE in case there was any question regarding that. Nasdaq, as we said, fully open, down 6%. That is a loss of 100 points. So let me also point out that the Friars Club did the open this morning. I don't know if it's a good morning for a laugh or not. Perhaps we all are going to need one after the day today. But let's take a look at the big cap technology stocks here. Microsoft certainly set up for a down day after that disappointing outlook, talking about a slow economy and the impact there, slow spending, PC unit growth slower than expected, et cetera, et cetera. You get the picture there. eBay is down 6.5%. And really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure. Yahoo down 8.5%. Cisco 6.5%. Research in Motion 10%. I'd like to go through these in case some of you are actually listening on the radio right now, so you get a feel of really where the kind of selling we're hearing about now. Google 7%. Intel is weak. I've been looking at the Philadelphia Semiconductor Index for weeks now because it's dictated the trading here. We're down 6.5% on the stocks right now. Let's go down to the NYMEX.
Oil down more than $4. Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day, but it wasn't enough to stem the slide. The slide is due today to what we're seeing in the global equities markets, and that's what these traders are focused on. They're looking at the slide in stocks around the globe, and oil is falling as well. But I must note that since the Dow has opened, we are not on the lows of the session. Oil had actually fallen below $63 a barrel. We are off of those lows, but still down $4.40 here at the NYMEX. A lot of folks in the developed countries are saying that OPEC cut should never have happened. The International Energy Agency is saying that it's going to do more harm than good to the world economies. Rick Santelli, over to you in Chicago.
Well, thank you, Sharon. You know, a lot of traders down here are actually amazed and impressed that the markets didn't do actually worse. The spiders were fairly accurate in where they priced pre-opening. If you look at what the lows in the S&Ps are, which right now we're still 10 points above, but everything's happening fast. Interest rates right on the opening at the lowest prices for equities actually saw their yields move up a bit and their price move down, which also makes sense because many people this morning, due to the uncertainty of equities, the wide bid-offer spreads, the lack of big places to trade with big volume, well, they hunkered down in there. Now some of those buys are moving and doing what they need to do in equities, pulling those out. But let's be clear, things like a 30-year bond, which had some very strange anomalies yesterday in the 30-year swaps, was a prescient indicator. 30-year yields, for many reasons, are now at the lowest level, or were at the lowest level they've ever been at. Mark Haynes, back to you.
All right, thank you very much, Rick Santelli. We have all 30 Dow stocks open. The Dow is down 436 points. I don't know whether all 500 of the S&P stocks are open. It is down 47 3/4. The futures are pretty much, after a big dip, down to minus 68 or so. They are back to more or less minus 60. It's an extremely volatile situation. NASDAQ Composite has come off its lows down 86.5. So, what are the pros doing? Should we care? Joining us, Wendell Perkins, Chief Investment Officer with Optique Capital Management in Boston. Fritz Meyer, Senior Markets Strategist with Invesco AIM. Wendell, we'll start with you.
Yes, good morning.
Buying opportunity.
You know, I do think this is a buying opportunity, but again, it depends upon your risk tolerance level and your time horizon. I mean, it's possible as we see multiples continue to contract that this market falls further. But at some point, we're going to see a stabilization and just a tremendous snapback. And if you look at how a lot of these stocks are priced in this market today, they certainly are as attractive as we've seen in 15 to 20 years, which has to be a good opportunity at some point in this market.
Fritz, what's the view from Boston?
Mark, you just used the word a volatile situation. A couple comments on volatility. First of all, volatility historically has spiked in and around periods of inflection, and that's where I think we are. So I agree with Mr. Perkins. Now, second and most important point on volatility. For stocks as an asset class, volatility is essential, as uncomfortable as that might sound. And the reason for that is volatility is what affords us the opportunity to earn the equity risk premium in stocks long term. The 5 percentage point differential we get in stocks over bonds in the long term. It's due to volatility. Don't let volatility shake you out of the market. Don't let volatility upset you. Let's ride this out and capture the extraordinary value that we see in the market today.
Art Cashin is with us, and Art, I want to get a sense from you of perspective here. We were halted, and now we're open, fully open. We're down 405. Is that a sign of a market that is perhaps more stable than you would have thought a couple hours ago?
Well, it's certainly not the amount of panic that was indicated in the foreign markets. This is like any other opening in the last 3 weeks.
Exactly.
You know, we've been down 400, 300, whatever.
Yep.
They are attempting to rally a little bit too early. I really would like to see a little bit more of a washout. We'll see how they progress as the futures move along. They took care of the first shock. And if we get a second wave of selling, we'll be there. You know, I've been writing for 4 weeks about that 1,000 point, maybe 2,000 point bottom. Monday's the best day of the year, last Monday in October, to put in a bottom.
And what is a bottom now? I mean, is that below the 7882.50 that we saw? I mean, how low is
it is
the
wherever
bottom?
the market stops selling, okay? That could be 7,400.
I was hoping for more clarity.
It could be 7,400, could be 7,000, but I'll tell you this.
Yes.
When they turn, the rally will be jaw-dropping. They will talk about this for generations to come.
We talked about a 1,000 point up move, Art. We had a 1,000 point up day, and it's all gone.
That was then. This is now, okay? You got to live in real time. History is good for teaching.
What are you going to say to convince Mark here that Mark, who has been sitting in cash for a long time, so he's a very happy man, should jump in?
The best time to buy in the market is when we have seen multiples contract to the point that they just basically can't contract any longer, because eventually earnings recover and the multiples recover, and where you get the most powerful returns over time is through earnings recovery and multiple expansion. We've already seen the contraction side. Earnings next year are coming down, but they're not coming down terribly. So there really is real opportunity. That snapback is out there. I do believe that completely.
I'm going to follow Bernard Baruch, who said, I'll give you the first 20% and the last 20%. I'll take the 60% in the middle of the bull market. So you know, you want to try and bottom tick this thing, more power to you. I wish you all the luck in the world. I'm pulling for you, but I'm waiting for a more substantial sign than that. Fritz, Wendell, thank you very much.
Oh, wait, hold on. Can I ask one more question?
Sure.
Fritz, I just want to jump one more question in here, and that's this, though. When Wendell's talking about earnings recovering, earnings will recover if we can keep borrowing and solve this problem that way. But what if we actually literally have to contract dramatically in this economy to pay the debt off? Does that change an earnings recovery and put it way, way out in the future?
I don't put it way, way out there, but here's the point on earnings. I think $100 a share on the S&P 500 represents something like normalized earnings power for the companies in the index. Whether it takes 12 months or 18 months, to me, is not so important. Warren Buffett's point was that at 900 on the S&P, divide by 100 in earnings, this market is trading at 9 times forward earnings. That represents terrific value. You can afford to sit around in these stocks and wait for that.
All right, Fritz, thank you. Wendell, thanks. Appreciate it. I know you're sneaking in bit by bit. You're dollar cost averaging.
You know, okay, nine on $100 earnings. Would you guarantee me the $100
No,
earnings?
that's the problem. No one knows.
No. Therefore, that whole argument, what are you doing over there? You're supposed to be...
Come on in, Dylan.
Trying to give you room.
Welcome in, Dylan. How are you?
Anyway, listen. It's a wake-up call. Any way you cut it. In other words, so the market didn't open down with a huge crash. Some people are actually irritated by that in the sense that they wanted the capitulation, and they're sitting here and they're saying, hang on, we're not getting it. But it does either way. What's going on in the stock market, and I know that the two of you know this, is a sideshow to a housing and debt problem in this country, whether we're down 400 now or 1,000 now, until we start to not only deal with the banks, which we did to buy some time. Now, Mark and Aaron, you guys know it, we have to deal with the houses. We have to go directly at the houses.
I'm glad you brought that up.
That's the real problem.
Especially with regard to the credit markets. It's kind of been lost in all the sturm and drang about the stock market, but for the last 2 mornings, short rates, the 1-month and 3-month bills, have actually started going down again.
I know.
They're not supposed to do that.
I know. The other aspect here, though, is what you are seeing, the same dynamic that is driving the cascade of selling in the stock market. In other words, as things sell, it makes more people that wouldn't want to sell have to sell, which makes more people want to sell. We are seeing that same dynamic play out in the American housing market, but it is a much slower process because while the three of us can trade stocks 100 times back and forth in a second, it takes months every time I transact a house. And as more and more people find themselves at or near underwater with their houses, their propensity to reach into their pocket, grab their house keys, and leave them on the countertop and walk out goes up. We have to stop that problem in order to stop the rest of it.
And it's amazing when you talk about this, I mean, we were hitting on it earlier with Fritz, but it all depends on people's willingness to buy American treasuries in some way, shape, or form to finance our getting out of this problem. If that willingness were to go away, then the only way you have to get out of that problem is a very severe contraction.
But that's also
and
why
right now, that's the question. It could be either one.
But that's why I also argue at this point, we went at the banks with the TARP to try to buy a little bit of time to deal with this. We need to go at the houses directly. We need to go at the houses to reduce supply, whether it's the NOSERA plan where you take a deed in and give it to the bank and now you can rent your house back, whether it's some sort of a housing credit in the military that creates demand for houses. We need a real plan to stabilize the housing market before you'll see any real relief here or anywhere else.
Okay, let's bring Matt Nesto into the mix here. What do you got for us, Matt?
Guys, you know, I did a piece the other day that was talking about holding support from that low that we hit in both the Dow and the S&P 2 weeks ago exactly. 7882 is the number in the Dow, and